Good evening, everyone. What I intend to do is show you how to open an account with my favorite investment platform in the UK. You might have guessed it's InvestEngine. Damien Talks Money did a video recently, and InvestEngine and Trading 212 still rank tops when it comes to investment platforms to use in the UK. Maybe I'll do a different video on Trading 212 at some point in the future, but tonight we're looking at InvestEngine. Bit of a disclaimer here. I do have shares in this company. They're not a public company at the moment, but I invested in them at an early stage. The reason I did invest with them was because I already used their product, and it's a fantastic product. So I will show you how you would open an account with InvestEngine, and I'll give you my current ETF portfolio on InvestEngine and the reason behind it. Let's go. So how do you get started with InvestEngine? You could go to any of my videos, including this one, and just click on the link. It's an affiliate link, so I do make a little bit of commission if you use the link, but you don't have to use it. Like I always say, you can always type InvestEngine directly into the search bar and it comes up. But I'm going to show you how you would do it if you were to support the channel. So, are we live? Yes, we're live. Excellent. So, welcome to MoneyGist UK. We will go to my last video. You will go to the description. I always tell you I keep loads and loads of links and resources in the description, but right here where you see investment platforms I use, there's a link to Trading 212 and there's a link to my portfolio on InvestEngine. If you click on that, it shows you how I actually split my portfolio. Something I like to remind people is, if you are interested in having an idea of how I invest at the moment, you need to look at the percentages, because I change those percentages occasionally. So you need to watch out for that if you want to copy my portfolio. But I'd rather you don't. I'd rather you keep it simple. Pick the ETFs that make sense. So you click on create your own. It will ask you investor type. Which investor type are you? Are you investing for your business? Like I know some people do. You have a business and then you take a profit of that business and you put it in the stock market. Are you investing as an individual? Most of the people I'm talking to are individuals. So it's asking you, you must be 18. Yeah, we are. You must be a UK resident. And you must be UK tax resident. UK resident, you're living in UK, you have a UK address, and then for you to open an ISA, you must be UK tax resident. So you put your email address. So now you can click on this finish your registration to ask you for all these details, and you can go to your mailbox to verify your email as well. When you finish the registration, it will probably ask you for your address, and you might need to submit a document, a utility bill or a bank statement, something that proves your address. So you have general, you have ISA, you have pensions. Now, these guys are actually targeting Vanguard pensions, so you can transfer your pensions here. You can open the self-invested personal pension, but today we're talking about ISA. What I want to emphasize is the fact that they have a general account and then they have an ISA account, because there are two types of investment accounts you can have. You can have a general investment account and an individual savings account. Now, the difference between the two is simple. If you invest in a general investment account, you invest as normal, but when you are done at the end of a year, you need to pay taxes on whatever you make from that investment. So whether you make it through dividends or you make it through capital gains, you need to declare it. You can always go to your reports, print out a report, and use it for your taxes. But if you open an ISA, you don't need to declare anything. Anything you make is completely tax-free, right? Because you already paid taxes on the money you're investing anyway, but whatever you make from this investment is tax-free. So I would actually open an ISA. So open an ISA, a tax-free investment, pay no account fees. So you have options here. So this is what I also wanted to emphasize. So you click on it, you can do your own ISA yourself, which is what I typically do. Or you can allow them to build a portfolio for you. So you can tell them what kind of person you are. This is what I do, da da da. So I guess for now you can really do DIY portfolios. DIY is what I would recommend anyway, so it doesn't matter. So like I said, you come here, look for, okay, they've already suggested the popular ones. There's S&P 500 or FTSE All World. I would just go with FTSE All World and add it to my portfolio. So your portfolio now has FTSE All World, and I think that's it. If I were you, this is all I need, because this FTSE All World contains 2,300 companies already. So what else are we looking for here? And so this one is accumulating, so it's not going to pay you dividends. If you want the one that will pay you dividends, you can delete that one and just look for whole world. So these are the different options you have. If you want the one that would pay you dividends, you can actually do here. You have accumulating or distributing. So accumulating the dividends means that you invest the dividends in your portfolio. Distributing means it pays it. When it pays it, you just see it as cash in your portfolio. So you can now decide to withdraw that cash, or you can reinvest it yourself if you want to. I like to keep track of the dividends that I'm getting paid. So I note it in a different document, but I reinvest it. So let's see. I'm looking for all world, right? You see, there are different types of all world, but what we're looking for is either Invesco or Vanguard. So it's one of these two. So let me go with the cheaper one that also says it has a higher yield. So I'll pick this one and I'll, not invest, add it to my portfolio. And that's it. I think that's fine. So I pick the Invesco All World. I pick the one with the higher yield that also has the higher growth. And I go to my portfolio. So let me see what my portfolio looks like. So you click on continuous. So you see, I could have added more securities and changed this percentage. Let's say I wanted to tilt, which I honestly won't recommend. So I'll continue. The single ETF portfolio, it's FTSE All World is 0.15, which is as cheap as you can get. I think this is perfect. So you can do a review. Now this review shows you how it's split. So you see emerging markets is roughly 5%, 60% is North America, and so on. And then when you look at the sectors, 25% industrial, 19% tech, 17% financial, and so on. And then you look at the big companies in there. It's again Apple, it's Microsoft, it's Nvidia, Amazon. So these are the companies you are effectively investing in. And once you get past the top 10 companies, everything starts to drop less than 1% contribution. So you see all these 3,000 companies, but Procter & Gamble is 0.5% of the portfolio. And it keeps going all the way down. You see Adobe is 0.2. You scroll all the way down, you see some popular names where you see the contribution is a lot smaller. But let's say I'm fine with this and I say continue. So what now happens is, if you add money to this, it would allocate it. So the more money you add, it continues to allocate it this way. If I had, like in my own case where I have multiple ETFs, it would allocate that money based off the different percentages. But like I like to say, there's no need to overcomplicate things. A single ETF tracks all world. Put your money in there and forget about it. Leave it. Don't worry whether it's going up, going down. Just leave it. And then you can also share your portfolio too, which is a nice and clean portfolio. What else did I want to show you? Yeah. Let's see, how has it been performing? Yeah, so like everything, it's gone up. This is maximum, but if you look at the last one, yeah, it's going back up. Yeah, so this is basically what InvestEngine looks like. It's nice and clean. When you arrive here and you go to, let me show you around. When you go to my dashboard, it basically just shows you where you have money. So if you have money, I know I've already opened this DIY, but there's no money in there. So I have an allowance of 20,000. So as you put money in there, it will be telling you how much your allowance is left. If you wanted to open a general one, let's say you've exhausted your 20k and you want to open a general investment account, you can open it here. So it's pretty simple. You land on your homepage, you see this, you go into your portfolio, you see how well it's doing, if it's going up or down. If you want to check it in detail, you can click in. If not, you come back out. If you want to add more ETFs, you can come to investment. That's where I went the other time. If you want to check the analytics, basically looking at the breakdown of your portfolio, this is what it looks like. I've kept this very simple. This is so nice. But you can see, okay, this is the breakdown of my portfolio. These are the sectors. These are the companies. And if anything has changed, let's say the index has changed, you will see it here as well. Asset class is basically equities. I have no bonds. But if you have some cash, it will start to show you have a bit of cash. Maybe you want to invest it. And then sometimes, if you have multiple ETFs, the actual and target may be different. In this case, because it's 100% one ETF, your actual and target will always be the same. But if you had multiple ETFs and one ETF is performing better than the other, then it would skew your actual and target. The more I look at this thing, the more I realize I need to simplify my portfolio a bit more. I'll wait out this crazy turmoil, this fluctuation period. And then when the market is normal again and we're back up, So transactions here basically will show you if you paid in money, if you withdraw money, if you receive dividends, it's also show up here. So you see here it's saying top ups where you pay money, withdrawals if you withdraw money, purchases if you ask them to use the money you paid in to buy shares, or if they sold the shares and generated money. If you've gotten dividends from your portfolio, it will show up here. Fees, if you transferred portfolio out and so on, it will all show up here. And you can filter by time period, last year, this year, and so on. Because we only have one portfolio and only one ETF, these ones are not giving me any filters. If you come to reports, you can generate reports that you use for your tax returns from here. So you can create a report, you can say create custom reports. So this CGT report basically calculates how much capital gains you've made. So you can generate your reports from here. But I just generally like the interface. And then you have all these ones, and we have all these videos and articles here that basically give you tips about investing. So this is their own promotion. How do you manage volatility? You may want to click on it and read the article. It tells you this is how you do, stay the course. Don't be like Modipeda is tricking in or what to change. Don't change anything. Selling your assets only cements your losses. So you see good articles here, or you can click here, how to invest on a budget. This is a video actually, not even an article. Yeah, I need to start a monthly investment habit. So this is a good video. I just wanted to show you how easy it is to open an account and navigate InvestEngine. Like, it's so straightforward. It's so straightforward. Just to navigate along the top, and that's it. So you see, this is what my own portfolio looks like. It's almost the same, but I've managed to do it with 4 ETFs instead of 1. Now you look at these ETFs that are here, you really don't need up to 4. You can see a list of 7. These are some that I invested in the past, but there's no need keeping them because they are overlapping with some of these ones. When I say overlapping, some of the stocks within S&P 500 are already inside the FTSE Developed World ETF, so there's no point keeping both ETFs within one portfolio. You just end up overweighting certain countries and certain businesses. So my current portfolio is just 4 ETFs. I managed to simplify it after my last conversation with DeepSeek. By the way, I just need to put this out there because of my other couple of videos that I've done. I know I give Gemini a lot of flack, right? But it's actually pretty good. Considering the fact that these AI models get upgraded so frequently, like you could check between last week and this week, the ranking could change so quickly. There's actually a website that you can go to check how the different AI models, Gemini, DeepSeek, Grok, GPT, how they rank compared to each other when you're looking at different tasks. Because depending on the exact task that you give the model, some models are excellent when it comes to copywriting and generating creative writing. Some are excellent when it comes to research. Some are excellent when it comes to finding live information from the internet. Some are excellent when it comes to general tasks and how-tos and know-hows and things like that. So you need to identify what tasks the AI model you're using is really strong with. For instance, I like Grok, but I've found out Grok is not really great when it comes to things like this investment stuff. It gives you ideas though. It gives you ideas in terms of the kind of information people are looking for, but it doesn't give you the actual information in terms of what to invest in. Now, the reason I brought all that up was just to remind you that in the last video, I had a bit of a deep dive with DeepSeek, and we more or less arrived at some principles, basically keeping my ETF portfolio simple and so on. So I actually went back, thought about it on my own, and I came to this. So the way InvestEngine works, it assumes your portfolio is 100% at any point in time, and then you tell it what percentage of that full portfolio you want to allocate to which ETF, right? Again, disclaimer, I'm not an investment advisor. Nothing in this video should be taken as investment advice. But what I used to suggest to my friends was to simply buy 100% VWRL. VWRL or VWRP. Now, these two are basically, it's the same ETF. The only difference between them is that one pays you dividends, so that's why you have this yield here, and one automatically reinvests the dividends in your portfolio. If you look at it, this ETF basically covers how many companies now? Roughly 2,600 companies globally. If you look at the regions, like 60% of that North American companies, that's basically the US and a little bit of Canada. 10% of that is Europe, excluding the UK, 5% in Japan, 5% in Asia, excluding Japan. And then you have emerging markets being 4.6%, which is effectively, the bulk of emerging markets is effectively China. So this is what your VWRL or VWRP would look like in terms of split. But what I've done with my own portfolio is slightly different, and I'll tell you why. So let me tell you a bit about the different things I've invested in. So VEVE is very similar to VWRL or VWRP. The difference is that it doesn't include emerging markets. So emerging markets is basically non-existent in this mix because it's looking at the FTSE developed world. The way the name usually is, it tells you that the provider of that ETF that put the ETF together, it tells you the index that they are tracking. So there are two big companies that create indexes. You have FTSE and there's MSCI. So the name of the ETF provider, the name of the index provider, and the name of the index itself. So in this case, when you look at VWRP, what you're looking at there is Vanguard being the ETF provider, FTSE being the index provider. An index is basically the list of companies with percentages of their weighting within that list. So S&P 500 is an index that looks at the top 500 companies in the US. FTSE 100 is an index that looks at the top 100 companies in the UK. This VWRP is an index that looks at large and medium-sized companies across the whole world. Roughly between 2,000 and 3,000 companies. Within that index, each of those companies is given a weighting, usually determined by the market capitalization, basically how much money has been invested into the company. Some indexes use other weights, but in most cases it's usually the market capitalization that they use for the weights. That's what an index is. Now, an ETF basically is a fund that tracks the index and invests money based off the index. So it's like saying the weather is tracked by the meteorological organization or the government organization that tracks the weather. And then you now have a TV station that reports the weather that is tracked by the Met. It's not the weatherman on the TV station that is tracking the weather. It's just reporting what the Met has tracked. So in this analogy, the Met is your index provider, the TV station is your ETF provider, the ETF is the weather information that they are giving you, the index is the weather. So there's the index provider, there's the ETF and the ETF provider. But that's just for you to understand what all this means. Now, usually in the past, my 100% would have been in this VWRP and go to sleep. But then something else to bear in mind is how much does it cost to invest in this VWRP. TER is basically your expense ratio. It's how much you are charged by the ETF provider for investing in that ETF. So in this case, this 0.22% that you see here is being charged by Vanguard, the ETF provider, for providing you this ETF that tracks this index. Now, there are other ways you could do this. It's possible for you to search for all world and see if there's any other ETF provider that's tracking the same index. So you see these guys, Invesco FTSE All World. So it's the same index, but now it's a different ETF provider. So it's like saying a different TV station. And these two guys are providing the same index. These guys are cheaper. And when you look at the size of the fund, so you see Invesco is pretty small, £900 million. Meanwhile, Vanguard is in £1 billion, so it's like 10 times bigger than Invesco. So that's one of the reasons why you may want to stick with Vanguard. But the point I was trying to make was that's one way to do it. Invest in an all-world index and go to sleep. The other thing to look at is that all-world index is basically a combination of developed world, right? Developed markets and yeah, so these are all indexes that track developed markets only. So that VWRL is a combination of developed markets and emerging markets. But what you see here is developed markets cost less compared to it. So developed markets is 0.12 compared to the full world, and that's because emerging markets is expensive on its own. See, that this is one thing I like about InvestEngine, the fact that you can do these searches and you get information. Although the other site I checked just now wasn't InvestEngine, I just checked just ETF.com as well. So what I usually do is I do a combination. So let's say in the total it was 95% developed and 5% emerging. So I would do 95% VEVE, which is the one that tracks developed markets only, and 5% VFEM. I like the one that gives me yield, but VFEM and VFEG are the same basically. And because I like to use Vanguard, usually the recommendation is that you should try and stick with one index. If you're using FTSE, stick with FTSE. If you're using MSCI, stick with MSCI. The problem is the way MSCI defines emerging markets is different from the way FTSE defines emerging markets. So you don't want to mix those. So what I usually do is I split it and I have 95% developed and 5% emerging, and that combination gives me the same as VWRL or VWRP, but sometimes I now dial up or dial down my percentages depending on how I'm feeling. Now, this is not a good idea. Don't do this at home. But in recent times, I've been feeling a bit bullish about China, so I've dialed up my emerging markets a bit, which is why you have up to 20% in emerging markets, which is high, and you have 30% in BEV. Now, these two combined is half of my portfolio. So half of my portfolio is split into what I'm using to replace VWRL. So instead of having 50% VWRL, which is what I used to have in the past, I now have 50% combination of emerging and developed markets, which is effectively VWRL, the all world. Now, the remaining 50%, I've split it between this world quality and Nasdaq. Both of them have a reason. World quality is close to what you have with VWRL because it's looking at all the markets in the world, but it's now applying certain rules to identify companies that have good fundamentals. If you read it here, it says this ETF is designed to provide exposure to global companies that are considered to have high quality. What's high quality? Factors like profitability, so they are profitable, they have stable earnings, and they have low levels of debt. These are things that I would have looked for myself, right? If you refer to my video where I talked about the features that I look for in companies I invest in, I'm looking for companies that have been profitable, basically making money. So they're profitable, their profit is growing, they're paying dividends, they are large companies. All those factors would have been applied. So the goal is to focus on firms that are financially strong and have the potential to perform well over time, regardless of short-term market fluctuations. When you look at the companies he picked, it only has about 300 companies here, but they are typically the top companies when you look at other indexes like S&P 500 or even your VWRL. So this is a way for me to streamline a bit so that I'm not just investing broadly, diversifying into 3,000 companies. At least I have a bit of a focus. If you check the performance of XDAQ in the last 1 year, let's compare it with VWRP. So you see they follow the similar pattern. If you look at it, it looks as if VWRL is actually doing better. See why I say sometimes just stick to the simple one. It's slightly better over a 5-year period. It's almost negligible. But when you look at it over a 1-year period, it's worse than VWRL. If I were you and I was looking at this, I wouldn't use it. But I guess it's because of all the fluctuations that are happening with the tariffs and everything. So you see what has happened in the last 1 year because of all these issues. Emerging markets, which is China, has gone up. Developed markets has declined. All world has also gone up, but less than emerging markets. So back to what I said earlier, that I'm maybe more bullish on China, on emerging markets than developed markets. That's one of the reasons why I did this split, because if I had maintained the whole, I would be up 1.1. This is not the time to start changing portfolio, not when the market is down. When the market has gone down and come back up, then you do your tweaks then. That's when you buy and sell, not when we are in the middle of it. And that might also be affecting these numbers that we're looking at. But that was my thinking, right? So roughly 80% of my portfolio is trying to mirror VWRL, trying to mirror global stocks. So this 30% VEVE plus 30% XDEQ is basically developed markets. So this is 60% developed markets, 20% in emerging markets, as opposed to 95% developed markets and 5% emerging markets. Have gone a bit hard on China. This is me speculating, and I always say don't speculate, so don't do what I'm doing. Because even when you look at the stupid results, it's looking as if I would have been better if I had done what I myself said. See why it's good to listen to your own advice, Modu. But then this 20% here that I haven't talked about is basically investing in NASDAQ 100. And why am I investing in NASDAQ 100? Because now is a good time to buy tech stocks, because the future is bright with AI and all these things, but then the prices are low because of tariffs and all those things. In my view, I may be wrong, so I'm tilting towards that. And NASDAQ 100 is not just tech stocks. Otherwise, I would have been buying IITU. That's why I had this IITU, because IITU is tech stocks. It doesn't include non-tech stocks. But NASDAQ has a few non-tech, because NASDAQ is not really tech. NASDAQ is non-finance, right? Everything that is not finance is inside this NASDAQ. So if, I don't know, Waitrose decides to become great, or let's see NASDAQ, what are the companies in NASDAQ? There's 101. There are 30 more companies in there that are not the IITU. But basically, it's me just trying to diversify properly. You can do all this analysis with InvestEngine, and it's still just ETFs. You can get all the information you want. Unless I want to do IITU, which is strictly tech, and with the uncertainty about the US, because most of those tech companies are all sitting in the US, I don't want to be totally dependent on the US. So that's my personal rationale behind my current portfolio. As you can see, it needs some work. Because looking at the results, again, they'll tell you past performance is not a predictor of future performance. But if I compare all of them over the last 5 years, XDEQ has actually done the best. But in the last 1 year, actually, emerging markets is doing the best. So it makes sense that I leaned into China, because they're holding up. Developed world is dropping. But this XDEQ, because it's mostly developed world, is dropping even harder. Because if you look at the companies that make up this XDEQ, this quality, they are mostly these big tech stocks and so on. And they've all been, and you look at the regions covered as well. This is 70% North America. So again, like I always say, don't tinker with your portfolio, especially in the short period, because I just made this adjustment recently. So leave it, let it go through that phase. A year later, I'll look at it again. This is a long-term exercise. Need tweaking it now because I'm seeing these things. It's a temporary dip because of the market's madness. It's like me just picking these points November 13 and saying, no, because of the numbers here, I'll make a decision for the next 12 months. No, wait, give it time. I've explained the reasoning behind my current portfolio, but you don't have to follow me. Just do VWRL and go to sleep. VWRL or VWRP. So look at my portfolio. Emerging markets is 9%. Instead of 5% that you see on VWRL. So I've doubled what emerging markets is contributing. Because again, like I said, I'm bullish on China. US is close to that, it's 59%, which is close to the 60%. If you want to compare directly with this one. So this is put 60% North America. My own portfolio is also 60%, 59%. But they are saying emerging markets 5%. Mine, I've doubled mine to 9%. I don't think these guys should be as high as, they shouldn't be higher than China. Europe, what does Europe have? It's just my own opinion. I may be wrong. And then I've squeezed Japan down. But maybe I should have actually increased Japan, because Japan seems to be doing okay for the first time in a long time. You know, so you have UK here, 3%. What's their own UK? 4%. So they are higher on UK. Right. It was actually because of UK that I had this ISF ETF, right? Because it's purely FTSE 100, top 100 companies in the UK. But I thought about it and I realized that I already have a number of UK companies in my trading 212. So that is the other bit you don't see with my portfolio. In my trading 212 portfolio, like half of it is UK companies. So I already have that skewing there. So I didn't want to, again, add another ETF to that. So I got rid of it here. So I'm not worried that my UK holdings are 2% here, because my trading 212 portfolio, they are higher. So that's it. I'm going to stop here. I hope it's clear how to open an InvestEngine account. Please do me a favor. Leave a comment below. Let me know what you'd like me to talk about in subsequent videos, and let's keep this journey moving. Maybe in my next video I might show you some other things I'm working on, because I'm trying to come up with an app that can help with recommending how you can split your portfolio between emergency funds and things like that. Basically do the exercise that I was doing with DeepSeek and Gemini. So you just tell it, I have this amount of money, because I keep getting that question from my friends. I have this amount of money, what should I use it for? Alright, so it's a popular question that people ask, and I've done multiple videos now on the topic, but I think an easy way is just to give people an app. So you just plug in the number and it tells you what you could do. So if you'd like to see how I actually come up with that app using AI, because I don't know how to code yet, I could record myself creating the app as well and share with you. It's a journey. Alright, have a good evening and see you soon.